Hello and welcome to SwitzerTV Property. This goes out every Thursday night on our YouTube channel. And of course, I'm Peter Switzer. On tonight's show, we talk to Sarah Hunter, BIS Oxford economics economist, and she passes judgment on whether we can trust the house price rises. Are they statistically right? And we'll also ask her, does the economy need tax cuts to get it growing again, which of course would help the property sector as well. And then we talk to Adrian Harrington from the stellar property business Charter Hall and discover how you can play property without actually going to auctions and hanging out with real estate agents. It's something that investors in property should have a real good look at. And finally, we talk to the CEO of Mortgage Choice, Susan Mitchell, and ask, is the home loan market improving with the house price rebound going on right now? That's the show. Without any further ado, let's go to Sarah Hunter. Sarah Hunter, BIS Oxford Economics Chief Economist, thanks for joining us.
Thank you for having me.
So let's just start off with the big picture. What's the economic outlook for the Aussie economy at this point in time, Sarah?
Well, it's that still a continuation of that sort of quite sluggish growth, really. On an annual basis, I think that growth is going to pick up to around about 2% a year over the next few months as we go into 2020. But for us, that's not particularly fast as an economy. So, potential growth is more like 2.7. So we're undershooting that. And really, there's two big drags that we've got right now. We've been talking about both of them for a while. One is around consumer spending, retail being the big example there. And the other is around residential construction and the housing market, but particularly now that residential construction piece, that downturn's got a fair way to go yet, and it's just going to be a drag on growth until we reach the bottom of the cycle.
Okay, now if the National Treasurer, Josh Frydenberg, was wise enough to take your counsel, would you suggest to him that maybe bringing those tax cuts forward might be timely and a sensible idea?
Well, it's certainly true that some extra fiscal support for the economy would help. It would drive jobs growth. It would drive some employment, and then that would get into household budgets and into spending and beyond. They've got a few options. One of those is to bring forward those tax cuts. So they're currently penciled to really start kicking in 1st of July 2022. That's quite a way away from now. Yeah. If they brought them forward, that would definitely help. There are other options, though. They could look at additional support for infrastructure spending. That's something the RBA have been highlighting just recently. But they could also look at current spending as well. So maintenance or extra funding for hospitals, hospital building programs, education, that sort of thing. So there's a whole range of different facets of fiscal policy they could use to support the economy if they wanted to.
And do you think that the rate cuts is losing a lot of bang for the buck, and it is in danger of maybe reigniting the house price boom?
In terms of bang for the buck and the impact it's having on the economy, I think it is a little early to say definitively that that's true. It takes a while for rate cuts to fully feed through. We typically think 2 years from when they cut to seeing the full impact. So we're obviously quite a long way away from that. The first cut was only back in June, so we're not even 6 months out. And having said that, there is some evidence internationally that as rates get closer and closer to that zero bound, or indeed go negative in some place, the impact that you get from an additional rate cut does fall away. So international experience does suggest that we're probably getting we will see slightly less bang for our buck around the impact. In terms of how it's feeding through to the housing market and house prices, it's definitely one of the supporting factors. I think we've obviously had quite a few that have really underpinned the turnaround we've seen since sort of around May this year. I mean, the federal election result and the removal of the sort of concerns around negative gearing and capital gains tax changes, that's obviously gone away. The rate cuts, we've also had the changes to the interest rate buffer test that APRA asked the banks to apply. That's also fed through as well. So I think there's a number of things that have really come together to sort of give us a bit of a lift in terms of the housing market, particularly in Sydney and Melbourne. So not just rate cuts, but clearly those markets have definitely turned the corner.
Okay, there's been a bit of a debate between two groups who try to statistically tell us how much house prices are rising by. First question to you on that subject is, do you believe that house prices in Sydney and Melbourne are on a rebound?
No, I think that there's enough data from enough different sources that looks to be the case. How much of a rebound? Yes, there's questions about that. There's many different ways you can actually measure these things, how you take account of the composition of the stock, and just in general, all of the price indices. When you have very low turnover, which we do still have, turnover's picked up a bit, so that's the number of sales in the market. It's picked up a bit, but it's still way below where it was through the boom years. But when you do have very low turnover, inevitably some of this data becomes more inaccurate. It's harder to measure what's happening to the average because one-off sales can have much more of an impact. So outliers become more important when your volumes are low. But I think there's enough data out there to suggest that yes, we definitely have come off the bottom. There's the various different price indices, there's the auction clearance rates, there's the volumes as well. Those are coming back through as well. So I think, and some of the lending data too seems to support that. So I think we've come off the bottom. We are seeing price rises now. What the gain has been since we were at the bottom, that's a bit more open to debate.
Okay, over the weekend, the AFR talked about how the house price recovery had led to a surge in building. Now, you guys look at that sort of thing fairly closely. Are you expecting 2020 to be better for housing and property construction?
No, we're the opposite. I think we very definitely think that we've got more declines to run. So if we look at tracking sort of construction activity, we're very lucky here in Australia because we get pretty good data from the ABS around particularly dwelling approvals. So and then commencements and then actual construction activity and then when the dwellings are completed. We can see in the approvals numbers that though the pace of decline is definitely slowing, they're still falling in year-on-year terms. We think they're going to continue to fall until we get into early 2020. So another 3-6 months from where we are right now. It'll probably look a bit different for detached houses versus apartments, but overall we think there's just a little bit further to go on that downturn, and then approvals should start to rebound. But if we're looking at actual construction work to do, we've still got to get through all of the decline that we've seen in approvals through this year and through last year as well. So there's much further for the residential construction downturn to run. We don't think that activity in terms of construction work done will trough until we get into late 2020, probably even early 21. So we're over a year away, we think, from the bottom of the cycle.
Can I ask you this question? Were the numbers before 2017, were they very high? And if you look at the pullback in construction numbers, how do they compare to the long-term average?
Yeah, it's a really good question. So they were certainly they were high. Absolutely, they were sort of the highest levels we'd ever seen. But I think it's really important to remember what you're measuring that to. And when you've got strong population growth, the way we do have here in Australia, you do have to constantly reset your base in terms of how much construction activity is needed year to year, just to sort of meet underlying demand, growth in underlying demand. So if we look through the boom years when we had approvals on an annualized basis around peaking at 240,000, that was very high. And at that point in time, we were estimating underlying demand was maybe 170,000, 180,000 dwellings a year. So quite a long way above that. We've fallen back very sharply. So we've gone from that 240, now we're sitting around about that 165, maybe a touch below. Now we estimate with the continued strength in population growth, the underlying demand means we need to add 195, 200,000 homes every year. Now, of course, obviously it's a cycle. So if you can't continue to add 240 when you need 200, that just can't continue. But clearly we need to come back quite a long way from where we are now to get back up to where underlying demand is right now. And as I said, we do the way we think about dwellings, we do need to constantly be resetting that level level and letting it drift higher naturally in our minds because we've got continued robust population growth. And certainly the migration data and the population data that we have hasn't shown any real significant signs of slowing in recent months.
Okay, now what's your outlook for a recession, either globally or in Australia? Are you expecting one 2020 or later than that?
So about starting with Australia, because I think that's an easier answer to give, a quicker one at least. No, I'm not expecting to see a recession in 2020 or a sort of in the medium term through the forecast horizon. I think importantly, we're talking about a lot of drags and a poor growth performance right now. The economy is still growing comfortably at around 0.5 percentage point a quarter. As I say, around about 2% a year when you annualize it. That's a long, long way from a recession. So no, I don't expect a recession in Australia. Globally, certainly there's much more of a risk there. There's certainly risks around the US economy and whether or not they will enter recession, and we're seeing quite a sharp slowdown there. And there's certainly some concern around some of the major European economies as well. We're waiting on the data for Q3, but we could see Germany, for instance, in a technical recession when we get that data. Maybe not, they might just avoid it, but if they do, it will be a sort of whisker avoidance. So globally, there's more concerns. There's a lot of headwinds that we're facing around US-China trade wars, although perhaps there's some, at least a partial cooling of tensions there. There's also headwinds across Europe. Brexit, of course, but there's some other issues as well around the German car sector and how that's spilling through the rest of the region. So globally, it's a bit more of a murky picture. I'm not expecting a recession in the global economy next year, but certainly the warning signs are at the very least flashing amber and in some cases maybe even red. So something I'll be monitoring quite closely and certainly looking at the spillovers to Australia. So if that did materialise, it would be a headwind for us to face. But as I said, if we're looking at the strict definition of a recession as 2 quarters of the economy contracting, we've got a lot of a buffer between where we are now in terms of growth momentum and getting to that stage.
Okay. Now, I was on 702 ABC with Phil Clark, the overnight show, earlier this week, and he said to me, but Peter, the Sydney house price market is a bubble, and he was quite emphatic about that. And I think it's not a bubble, I just think it's a boom. Have you ever thought about whether the Sydney and even the Melbourne market are bubbles?
Well, I think that it's worth keeping in mind that there's a number of quite supportive facets to Sydney and Melbourne that really do underpin those house prices. Yes, they're very elevated and the household debt levels are very elevated. And it's certainly true that if I look from where I'm sitting right now, no matter what the degree of bounce back in prices that we've just seen, if I'm looking forward through 2020 and beyond, I think it's going to be relatively subdued price growth compared to what we saw through the absolute definite boom years, particularly 15, 16 and 17. But those underlying fundamentals are pretty positive. It has become more affordable to take on a mortgage with all of the changes we were talking about earlier. Those economies, if we look at their unemployment rates and then their trajectories for household income and gross state product, that sort of thing, they look very solid. These are both parts of the country where the unemployment rate is sitting close to 4%. So they're effectively operating at full employment. So household income is there, and people do have an ability to service their mortgages. And so that doesn't suggest that we're in bubble territory. So I'll put another way, if we look at, say, Ireland and the UK and some of the other economies just prior to the financial crisis that saw the biggest property market corrections, it did look like there were problems there because we had issues around impairment rates and people not being able to pay their mortgage and those very overinflated values creating problems in the banking sector. And we don't have that here. There aren't any signs in the data that we can see right now that we have to be concerned about those sorts of shifts taking place. So if we're thinking of a bubble as being risk and trying to identify those risks, hard to see them right now. But
Okay.
certainly true that obviously prices are high. We've had robust growth in the recent past, and that's why I think going forward, once we get a sort of more of a normalization on the sort of the coming off the bottom of the cycle, I think we'll see fairly subdued increases in prices because they will be constrained by income growth and some of those fundamentals as we go through the medium term.
Okay, and one last part and related to this question. He said, London's cheaper than Sydney. You're a girl who knows London better than me. How does Sydney house prices compare to London prices?
I think it depends on where you look in London. You can certainly find some very expensive property in London, at least as much as you can find expensive property in Sydney. So I think that's probably another important point to make, right? We talk about the Sydney market or the Melbourne market being one market. It's not. It's a collection of different parts of cities that people might want to live in, where prices for properties are wildly different. So, and that's true in London as well. And so you can find some beautiful property here, but you can also find some very nice places to live in London too.
All right, Sarah. Well, I'm going to conclude that you were supporting me rather than Phil. I'll pass that on to him. Sarah Hunter, BIS, Oxford Economics. Thanks for joining us.
Thank you.
Adrian, thanks for joining us.
Thanks, Peter.
So explain to us who Charter Hall is.
Okay, Charter Hall is an ASX-listed property fund manager. We've been on the stock exchange for many years now. Our mantra is to find good quality properties and provide funds for our wholesale investors or large institutional investors, and our retail investors to access high quality property for the market.
Okay, so you've got listed and unlisted vehicles that people can invest in, right?
Yes.
So why don't we start with the listed first? What are the listed products?
Okay, so you can invest in Charter Hall, which is the manager, and we're separately listed under the ASX code CHC. Then we offer 3 listed retail REITs that cover the CLW, the Long WALE REIT, and that's a diversified portfolio of property looking at long-term leases to quality covenants. We have the CHC Retail Trust, which is focusing on convenience retail centres. And then we have the CQE, which is the Charter Hall Social Infrastructure Trust, which is the largest owner of childcare centres. And it also has a wider mandate now to invest in social infrastructure, and recently bought a bus terminal lease back to the Brisbane City Council for 20 years.
Okay, and I believe you've bought Telstra exchanges as well.
Absolutely. So
what product is that in?
That's in a couple of our funds, because one of the benefits of Charter Hall is we have unlisted funds that are backed by institutional investors. We have unlisted funds that mum and dads can invest in. And then we have our listed REITs as well, which are listed on the ASX. So we bought the Telstra exchanges for $700 million in a joint venture with Telstra. It was a sale and leaseback. And that's gone into a couple of our funds, including the Long WALE REIT, that CLW, that's listed on the ASX.
Okay, so if someone just wanted to be in a single property, do any of your funds have just like one property so people can actually go and see it and invest in?
No, Charter Hall doesn't do single asset funds for the mum and dad market. Our view is that we try to build a diversified portfolio of properties. So at the moment, we've got 4 retail funds for the mum and dad market. One is the direct office fund that owns a high quality portfolio of both CBD office and suburban office properties. PFA Office Trust, which owns a broad-based portfolio of office properties. We have the industrial fund DIF4, which owns a broad portfolio of industrial property. And we have the Consumer Staples Fund, which is investing in a range of convenience-based retail. So there's a broad cross-section of product there to meet the needs of the investor.
So if someone goes to your website and runs through the various products that you have either listed or unlisted, they get a rough idea of what lies inside those particular products?
Absolutely. We have on our website all the properties that are there. We list the tenants, we list the weighted average lease expiry, which is very important in this era where everyone's focused on income and the security of income. So typically most of our unlisted funds that are available to the mum and dad market have WALEs or weighted average lease expiries of circa 10 years.
So that means that the tenant is likely to be there for 10 years.
Absolutely.
Okay.
So you get, and with generally fixed increases in rent. So over the course of investing in those funds, the security of income is absolutely paramount to us.
And what's the typical kind of yield that comes out of those sort of funds?
For instance, our Diff 4 fund, which is our industrial fund that has 10 properties, the yield on that at the moment is around 6.2%.
Yep.
And our PFA office fund that just recently bought a 50% interest in a building in Macquarie Park that's 73% leased to the New South Wales State Government. Brand
Well,
new
they're
building.
not going
They're not going anywhere.
And that's the important point,
Yeah.
that the solidity of the tenants are critically important, particularly if a recession comes along.
Absolutely, and that's what we. It's all about resilient income and the quality of the tenant covenant. Because at the end of the day, we'll have cycles. Prices will go up and down. But in a low interest rate environment where people aren't getting much money in the bank, it's very important that security of income and knowing that every quarter the distribution is going to be there, and that's what we focus on.
So the one with 73% tenancy of the state government department, what's that one called?
That's in two funds. So we put half of it in the CLW fund, which is the listed REIT, and half of it is in the PFA office fund.
Okay, and what kind of expected return do you have on those?
So the PFA office fund has a current distribution yield of around 7%.
Okay.
And being in the listed market, the CLW is looking at an operating earnings yield at the moment of about 5.2%.
Okay. If someone wants to go into the listed product, well, you just govern by the minimum that is accepted by the stock
your
market.
broker, absolutely.
Right.
What's your broker?
But if the unlisted one, that's when you guys would determine the minimum contribution. So what's the
typically $20,000?
Okay, so that's very accessible.
Very accessible. They're open daily, so we can take money every day. We've got daily unit pricing in them. They have limited withdrawals every 6 months, and then every 5 years there's a major liquidity review which allows people the opportunity to redeem their capital if they want. So they're exposed over the course of the fund to a growing portfolio of property, but at the same time we do recognise from time to time people do need liquidity.
Okay, and talk about the Charter Hall product that is like the overarching company that's listed on the stock exchange. Does it reflect basically the success of all the unlisted and other listed products?
Absolutely. So the Charter Hall has about $35 billion in funds under management now. Absolutely. And that comes from a mixture of both superannuation funds, global pension funds, and then from the listed market through those three REITs that I mentioned earlier, and then through the mum and dad market. We've got about $5 billion invested through our Charter Hall direct business, which is focused on that market.
So imagine that someone watching this has never ever even thought about getting into property the indirect way, effectively by using you guys. Is there anything else you think they should know?
I think at the end of the day, it's all about being comfortable with liquidity, understanding that if you're investing in unlisted property, you're taking a long-term investment. The second thing is to look at the quality of the covenant. It's absolutely critical to understand what is driving that income into the fund.
That's basically the rules of engagement.
The rules, absolutely. Who are they going to be there in 6 months, 12 months, 5, 10 years' time and be able to pay the rent? The quality of the property, because more and more tenants are looking for high quality property. Where to go, sustainability of the property is very important, the wellness, the amenity inside the property. All of our major tenants now want amenity in their buildings, and it's not just having a cafe at the bottom, it's the end of trip facilities, showers, bike racks, that sort of thing down in the basement. And fundamentally, at the end of the day, it's looking at the market you're in. So the markets move back and forward. and being comfortable with the location of the property and what sector it's in, because at the moment we're seeing retail not performing as well as industrial and the office markets, and just being comfortable with the exposure that you're taking.
Yeah. Do you guys ever sell a major property and that has an impact on the distribution that comes through?
No, we are actively curating our portfolio, so that means that we are looking at both buying and selling assets. We're not afraid to sell an asset if we believe that we've maximised the return from it.
And the capital gain is extraordinary.
You need to do that because buildings that you bought 5-10 years ago now may have come to their useful life. You're always looking at how you can better position the portfolio for the future income stream going forward. So,
great stuff. Thanks for joining us.
All right, thanks, Peter. Appreciate it.
So that's Adrian Harrington from Charter Hall. Susan, thanks for joining us.
My pleasure.
Now, last time I talked to you, you scared the pants off me.
Oh dear.
And it was when you made the revelation that 1 in 5 people who used to get loans weren't getting loans. And that was probably over a year ago. And that's when I realised that the home lending restrictions was going to be a serious economic problem, which of course we're seeing now because the economy is not doing as well as some people thought. Has that changed?
No.
Oh no, well you're scaring the pants off me again.
I think there are a couple things that are different.
Right.
First of all, the processes of the banks are a little bit better. It's still some lenders still take 10 days to pick up a file, but the process is getting a bit smoother. Brokers are now cognizant of what it is that they need to make sure is in the package to ensure that the customer gets through the process as quickly as possible. I also think that they can warn customers now earlier saying, you're going to have to prepare and get mortgage fit before we go through and do this application. I'm sorry, I don't think yours is going to get through. So they can go away and look at their spending and some of the other things. I don't believe that the responsible lending pendulum will swing wildly back. We have made a step change to a new level of lending criteria, and I don't expect it to go back.
Yeah, so all those people out there, and there are not many of them, but there is a group of people who are so stressed about the banks being so irresponsible with their lending. The fear that this new house price recovery might lead to irresponsible lending, and you can allay their fears, can you?
I don't think they need to worry about that, but I understand where you're coming from. Some of those fears are looking at like a 2% or a 3% of the population, and they're projecting that on the entire Australian population that wants to go and borrow money, who actually might just actually be very responsibly borrowing. Let's give them the benefit of the doubt.
Yeah, let's do that. Let's do that. The house price recovery.
Yep.
I know it's not your exclusive beat, but you must have a view on it because it probably does determine who shows up to your organisations looking for loans. Do you think the house prices are recovering?
Yes, I think the data shows us that the house prices are recovering a little bit in Sydney and in Melbourne. I don't want to say across all of Australia. I think Darwin and Perth are still seeing some troubles there. I do think it's a bit early to tell because from what I understand, the listings don't look like they've gone up as much. So you're seeing a demand and there's not maybe necessarily enough supply. So I'm not the economist, but I would say that if you had more supply, perhaps that price wouldn't be going up as sharply.
Okay. Are you in the camp, and I think you are, but I'll ask the question, are you in the camp that the Royal Commission was very unfair on mortgage brokers?
I would say unfair on intermediaries, mortgage brokers being one of those intermediaries. It was supposed to be the bad behaviour of the banks, and I can't actually tell which one of those laws that they've given us the list of the laws that they're working on, and none of those seem to be geared at the banks. So they seem to have given more money to APRA, I guess, to turn the screws on the bank, and that's the way in which they've done that. I do think it was a little bit unfair on mortgage brokers. My theory is that perhaps there was a bias there, and they asked the questions to confirm the bias, that the brokers were perhaps placing their customers just to get the highest commission. I actually don't think at a ground level, knowing the brokers and what they do, I just don't believe that they do that.
No.
Now, of course, I'm going to say that's what people are going to say.
Yeah, but you're saying a minority might be bad behaviours, but I reckon there's probably a minority of accountants, lawyers, doctors, plumbers, even economists who might behave badly.
I think that's probably true, and I don't believe that it's indicative of the group overall.
And as I was listening to you, I was thinking, well, if my mortgage broker is getting a bigger commission sending me to, XYZ bank, but my home loan goes from 4.5% to 2.9%, I don't care. I don't care what he's paid, as long as I'm better off.
When you talk to the customers, you're correct.
Yeah.
You're correct, and they don't necessarily come in and say, I want to borrow responsibly.
No.
What they say is, I found a house and I really want to know if I can afford it. Because it's about buying the house. It's not about, that whole thing surrounding the...
And banks determine who can afford a house, not mortgage brokers.
I think that's true. The mortgage brokers are there to say, I know the market, I know where your particular fact pattern, your income type will best fit in for you to achieve your goal. And that's really what the mortgage broker does, is just take them along the little journey from where they are to the bank that will serve their needs.
What do you think of the new first home buyer scheme, which effectively helps younger people, first home buyers, get deposits?
I think it's interesting. First of all, I think it's fascinating that it's sort of first come, first serve. So that doesn't seem...
10,000 a year.
Yes, so that would imply that it may not make a permanent change in the market if it's only just a few people that get it, first of all. Second of all, I understand that there's some confusion as how that's actually going to work with mortgage insurance. So I'm not quite sure how that ends up working out in the long run.
I've kind of presumed that the government must be going to
Yes,
take responsibility for the insurance aspect
absolutely. So I'm not quite sure how that then works with mortgage insurance. Or if
does that mean that you don't need it, because if something goes wrong, the taxpayer is going to say, oh, well, we'll take the role that Genworth used to play?
I'm a little bit concerned that might be what happened. I don't know enough about the detail to know that, to be honest.
Okay. Yeah, as is one. And
probably. And I'm not sure that it's available as it should be.
No, okay. It's a good question to ask.
It is an excellent question.
All right, now, have you seen any evidence? And this is a question I haven't prepared you for, but you know
okay.
you beat. Have you seen any evidence that young people are using the Super Saver scheme? Where they actually put money in, grow it over 2 or 3 years, and they can draw $30,000 each out to buy a home?
I'm sure somebody's using it.
Yeah.
But no, our evidence is not that it's not widely being used.
Yeah. I think it's a good idea.
I think it is a great idea. Yeah. It's just because it makes them save. So it's not like you're giving it to them.
In a good tax environment with higher returns than term deposits.
Absolutely, and it gives them an opportunity to maximise it, but the behaviour is the same. They still have to save to do it.
Okay. Now, I want to ask you, do you think that the housing market's improving at this point in time?
Improving meaning the prices are going up? Is that your definition of improving?
No, people want to buy homes. The position of being able to get a loan compared to, say, 12 months ago, is it getting better or about the same?
I think they can borrow a little more money because the rates are going to be lower, so that makes a difference.
And the APRA cap.
But if the house isn't there to buy, then I'm not sure that it's improved the market, because the whole point is to buy a house and have the house there. And remember, the prices are still internationally high.
Okay. Yeah, and you made me think of another good question to ask, which I presume is a good question, is, has all these concerns about apartments in Sydney in particular, apartments cracking up, cladding issues, do you think that's actually hosed down the interest in apartments?
No, because I think that the apartments are at the price point that works for most people. So I think if you're sitting here between I'm going to rent or I'm going to buy an apartment, but I can't afford a house, I can either rent or buy an apartment.
Yeah.
Because the price point is there, I think they find their way through that.
Yeah, and I guess people who want to buy something, get on a property ladder, they would make sure A, there's no cladding problem,
Well, at least
and B, there's no cracks.
well, as you know, of course, education's the best thing.
Yeah.
Now that it's been in the papers, they'll have the opportunity to ask those questions, which is by far the best result.
Okay. Well, the next obvious question is, what's the outlook for Mortgage Choice? You're the CEO.
I am. I think the outlook for Mortgage Choice is good.
Yeah.
We've gone through the Royal Commission. We've had this miracle election result in May. The people are back out in the market.
The negative gearing, all that sort of.
Yeah,
and
all
they're not
that-
being political, saying you love ScoMo more than Bill. You're saying that all those property implications have gone away.
Yeah, so the property implications are off the table. The broker commission implications are off the table. So we've got a network of people who are so happy to be back at work
Yeah.
and busy generating business and making money for their small businesses. And that's got to be great for Mortgage Choice.
Okay. Now, what's a really good question I haven't asked you that I should have asked you?
I thought you were going to ask me about the ACCC
Well, there you go. See,
price inquiry.
Okay, tell us about that.
I think they're going to find that pricing is opaque, which is what they found last time
So,
and what they found the time before that.
okay, and so this is the pricing of loans by
Yes.
banks.
Yes.
And what do you think they want to find?
I think what they want to find is they want to find some miracle solution whereby there is a mechanism for the people who are in the back book and have a much higher rate to get them onto more of a
lower
current rate, a more current rate. Because 20 years ago, everyone paid SVR, standard variable rate. Then what, about 10 years ago, 11 years ago, people started getting discounts. And then as we've progressed, the discounts get bigger and bigger and bigger. So now you can get a discount as much as 1.5 to 2. They're quite sizable off the SVR, depending on your loan to value ratio and the size of your loan and some other factors.
Yeah, well, are you a great customer who spends all
Exactly.
their money at the bank? Of course, some of those people don't get the discount, but some
Right.
do.
But the point is if you go back just maybe a year or two ago, probably pretty good. But if you haven't really looked at it in 7 or 8 years, then you probably do have the opportunity to get a better rate without a whole lot of work. That's one.
Even without the ACCC, you just have to go in and say, I want a better rate or I'm switching.
And if you're not happy doing that, you can probably ask your broker to do it.
Yeah.
The brokers will call up and say, I know what the market is right now. Come on, give my client this rate or I'm going to refinance them to a person who will. So there's a great opportunity to do that. And I think with 3 rate falls in a very short period of time, people are very focused on what the rate is. So it's actually a good time to do something about that.
And is it kind of like, in a perfect world, it'd be lovely that everyone gets charged the same low price. But does that mean that the ACCC will start making lawyers charge everyone the same price and financial planners the same price? Every business in the world operates, many businesses operate. Like, for example, David Jones. What the suit they sell at the beginning of the season is much more expensive than the same suit sold at the end of the season. Does that person come in and get a rebate?
Yeah, I take your point, but I'm with you a little bit. I'd like for the process of figuring out the pricing to be clear because I want the consumer to be educated, and if that's what comes out of this, that's great.
Yeah, okay.
But on the other hand, if you set one price, then you've got the group whose credit is better not getting the advantage anymore. And they earned that. They earned that by good behavior. They earned that by saving that money and having a lower LVR. Why not let them have it? So that's the part that I am concerned that will come out of this, is that they want you to advertise a price and then that's the only price.
Yeah.
And I think that takes away from the opportunity for people to be rewarded for good credit rating.
Yeah, that's a good answer, by the way. Very good answer. You're good at this, aren't you?
It's a lot of fun to do.
Susan Mitchell, thanks for joining us.
Thank you.
Insights into the Australian home loan market with Susan Mitchell.